All right, if everyone is ready, we'll start. As you can tell from the screen, this session is about global financial regulation and the governance of capital flows. And my name is Pierre Siklos, and I'm affiliated with the Bosley School next door, as well as Wilfrid Laurier University. And of course, I'm also a fellow at CIGI. And like the previous session, I'll begin with some remarks and then turn it over to the panelists. When I was asked to write the background paper for this session, I thought I would do a couple of things. First, I thought I would organize my thinking by focusing on the G20, not so much because of whether it's the legitimate organization or group, but simply because, given that we are at CIGI, it seemed to make a lot of sense. Also because the other advantage of doing it that way is that you have a nice subdivision of countries that are considered to be advanced industrial economies and emerging markets, and there's some interesting differences between the two groups that I found useful in organizing my thinking. And then lastly, because I was asked to not just to relate the problems and the challenges, but to provide some idea of the way forward. If you'll forgive a little French, there's a famous French expression, la critique est aisée, mais l'art est difficile. And essentially, it means it's easy to criticize, but to provide some constructive solutions is a lot more difficult. So with that in mind, in organizing my thinking, the first thing was very clear when you focus on the G20 and you look at the last several decades, it's very obvious that if you classify financial crises, whether they're systemic banking crises, currency crises, or sovereign debt crises, there's a marked division between the advanced economies and the emerging markets, with the latter having experienced many more crises of all kinds than the former. But of course, the former is notable because the latest crisis is considered to be a systemic banking crisis, among other things, and it's centered in the advanced economies. And if you have access to the paper, I'll not point to particular figures. You can look at that on your own. The other notable aspect, of course, of the last crisis, it's a systemic variety. It's the systemic component, which was not as present, say, in the Asian financial crisis. Although at the time, certainly even in Canada, we thought that the Asian financial crisis might spread beyond the Asia Pacific. And then, of course, because it's systemic, we tended to think of crises, whether they're financial or other varieties, we tended to ignore sort of the interconnectedness and the complexity of financial institutions. And clearly in the last crisis, that's become very much a focal point of the debate about how to regulate finance and, by implication, capital flows. But beyond the classification of crises, the other thing that, at least in preparing the background paper, I found interesting to my time, in my case, is that the spread of crises is not constant over time. In some crises, and I gave the example of the Asian financial crisis, it affects one part of the world but not the other. But in this particular crisis, although the severity of the effects varied, in this crisis, basically the entire globe was affected to a greater or to a lesser extent. And then beyond whether economies were coupling or decoupling in terms of their business cycles, we saw something that was not as evident in many of the other crises in the past, which is the spillover from the financial sector onto the real economy. Many thought that you could sort of ring-fence effects from the financial sector onto the real economy, but we now know that the two are intimately related. If we then step back and look more closely at the differences between emerging markets and advanced economies, the other thing that's notable about the latest crisis is how in the emerging markets, one of the reasons they may have weathered the crisis better than others is because, if you buy the data that I use at least, they allowed monetary independence to increase. So they were able to absorb the shocks from abroad. And at the same time, financial openness also rose. After all, some, but not all, these emerging markets don't have financial systems that are as sophisticated as ours, but the global financial system allowed them access to funds outside their own country. So the combination of greater monetary independence and financial openness helped them absorb some of the shocks. And you can also see that if you look at classifications of exchange rate regimes. Interestingly enough, in the emerging market groups of the G20, you saw them, on average, aiming or tending to allow their currencies to float more freely, whereas a slightly opposite was true of the advanced economies. Again, this is all dependent on whether you buy these classifications of exchange rate regimes. So that's the background. Now, in terms of the response, what do I see as some of the dangers? And I'll focus on three. One, if we look at the fiscal response, we saw that it was fairly immediate and fairly large, although, again, if you look at the IMF's work in this area, you will see that the fiscal response was considerably larger in the advanced group of the G20 than in the emerging market group. But similarly, we find that the U-turn towards austerity was also much sharper in the advanced economies than in the emerging market economies. And so we somehow see that emerging markets perhaps learned another lesson that some of the advanced economies did not, which is it's fine to argue that when the crisis is over, you should restrict fiscal policy somewhat, but perhaps not to the same degree or at the same speed as in the advanced economies. And then the second danger, which is a little bit closer to my heart, and I find it both more problematic and complex, is that central banks became essentially the only game in town. And there was a tendency for politicians and policymakers more generally to assign more responsibilities to central banks without having thought through what are the consequences. And so in some economies, of course, financial stability became an additional objective, but we still don't have a consensus on what we mean by financial stability, how we regulate it or control it. And then there's a tension between financial stability, generally speaking, and monetary stability. We have a fairly good idea of monetary stability. It's something that's forward-looking. It has something to do with price stability. We can argue whether you need an inflation target, a formal one or a numerical one or not, but that's what you need for monetary stability. But financial stability tends to be more backward-looking. When we think of these macroprudential instruments, they tend to be backward-looking instead of forward-looking, and ideally there should be some forward-looking element to it. And that gets us to the third danger, which is there's a danger that we learned the wrong lessons from the crisis, and in particular when it comes to capital controls. It was mentioned in the first session that some economies instituted some types of capital regulations, but for the most part, the emerging markets avoided that. They used that as a signal from time to time, but contrary to some of the more recent research at the IMF, which is suggesting that maybe under certain circumstances capital controls might work, most emerging markets have sort of taken a more neutral position. And in fact, if you look at the extensive literature on capital controls, you'll certainly find some evidence where it's worked. But broadly speaking, the lessons are that we really don't know if it does work and when it does work. And so perhaps it's best to leave well enough alone and try to avoid capital controls wherever possible. So with the background and some of these dangers in mind, how do we go forward? Well, at least from my perspective, I've come up with sort of five suggestions. At least I would say only perhaps one of them might be novel. The others you'll find mentioned by others in several publications. One is, I think I was hinted this morning, which is that countries should get their own house in order. And that means achieving some kind of balance or harmony between fiscal and monetary policy. Cooperation is certainly desirable, and certainly more desirable than coordination, but rather than try to find a narrow set of rules, it's probably better that countries develop an acceptable range of behavior and then allow them to operate within that range. How wide that range is a difficult question, which I won't deal with here. Third, transparency is very desirable. If you look at central banks in particular, and particularly in emerging markets, the amount of monetary policy transparency has risen quite substantially over the last 2 years. Of course, they had much further to go than the advanced economies. But transparency is necessary, but is not a sufficient condition. The important problem is, where does accountability lie, whether it's for monetary policy or more generally financial system stability. And so as a result, the fourth idea is that, and I think this was sort of hinted at the first session, but I have a slightly different take on this, is that it's probably best to have accountability reside with the individual countries rather than, which is typically often the case, the international financial institutions. When something goes wrong, you tend to go to the international financial institutions, or it's these institutions that apply moral suasion. Whereas it's probably best to design a system where you have an escape clause, which allows individual nation states to step out, if you like, of the rules of the game. But then the responsibility it's incumbent on them to explain to the international community why they feel that the current system does not work for them, rather than the other way around. And then lastly, when it comes to the G20, one of the motivating, one of the sources for the creation of the G20 was to group together systematically important economies, which is on the surface a good idea. The problem is that you then face the problem of what economists refer to as Goodhart's law, which is that once everyone knows that these economies are the systematically important ones, you tend to forget that there might be another economy down the road which, to your surprise, might eventually become systematically important. So we discussed last night the issue of the size, the legitimacy of the G20, and those are, I think, important issues. But just to organize a group of countries along the lines of ones that are currently systematically important can raise some difficulties. And I think with that, I'll stop there, and I'll turn over the discussion to the panelists. And like this morning, each has 5 minutes, and you have their biographies, and so I don't need to say too much. And we agreed that we would go in on an alphabetical basis, so we'll begin with James Aitken, please.
Thank you, Pierre, and thank you to Jim Haley and the event organisers for including me in this wonderful and interesting discussion. Raise your right hand if you feel you understand how our financial system works. Good. Don't worry, you're not alone, but I think that goes to the heart of some of the problems that continue to bug us 5 years after the crisis. By way of setting the scene, since the end of Bretton Woods, our financial system has evolved from one that was funded by intermediaries to one that was financed by markets. And there is, of course, a very big difference between the two. The first one is that the magnitude of the extent to which the financial system is now critically dependent on market-based funding. Essentially, our financial system is leveraged maturity transformation on unstable foundations. And those unstable foundations include things like tri-party repo, money market funds, of course, and wholesale funding in general. In other words, what we have is a financial system which engages in leveraged maturity transformation on a bed of hot money for which there is no backstop and no obvious lender of last resort, and which, of course, dominates the entire financial system. The second big difference, if we compare, say, the early 70s to today, is the technologically enabled speed with which such hot money financing can be assembled and, of course, withdrawn. And this raises an awful dilemma for central banks. Now, I should not say all central banks, merely those central banks who, over the past, say, decade or two, have been charged with financial supervision and financial regulation. So we could argue that central banks, the ones I defined, have allowed the financial system to evolve in ways that perhaps it should not have. And those central banks now find themselves struggling to adapt their lender of last resort responsibilities to the new reality. And as a matter of fact, under Dodd-Frank, it is not impossible but it's much more difficult for the Federal Reserve to deploy Section 13(3) of the Federal Reserve Act, which is how they prevented the entire implosion of the US financial system during the crisis. So there's that dilemma for central banks, and yet at the same time, their stated policy intention, again in some obvious cases, at the same time their stated policy intention is to sustain an addiction to a level of growth and a level of leverage in the financial system that is neither sustainable nor consistent with real economic growth. Apart from that, it's all good. But in terms of regulation, which is obviously one of the key areas we're going to discuss now on this panel, one thing that concerns me is that the solution to what we've been through over the past 5 years is always and everywhere to have banks hold more capital, which is understandable, but also hold more and more liquid assets. The problem with that is that the liquid assets, the financial system, not just the banks, but the financial system are forced to hold are paper claims issued by countries in very parlous fiscal situations led by the United States. It is true to say that T-bills, US T-bills, make the world go round, or at least those are the instruments that underpin the entire financial system, and to a lesser degree, Treasury notes as well. So that's the first thing that bothers me, and if I was to imagine what the next financial crisis might look like, my bet would be it would be a crisis in so-called safe assets. Related to that, there is the assumption that because you hold more liquid assets, you are liquid. Nothing could be further from the truth. It depends where you hold them, it depends how many times you've relent them, and so on and so forth. And finally, just briefly, Pierre, on the FSB, obviously it's run by chaired by a very capable man. Governor Carney is one of but two G7 central bank governors with any practical, non-model driven financial markets experience. And I think that goes to part of the problem as well. Thank you.
All right, thank you very much for staying on time. So next we have Marshall Auerbach from INET.
Thank you, Pierre. And I'll second James's comments about thanking Rohinton and the other members of CIGI for inviting me to speak at this august conference. I will try to link this marginally to the previous session. I mentioned to Jim Haley in the interval that it is interesting that we continue to go on about fiscal problems and fiscal sustainability. This was, after all, primarily a crisis of private debt, not public debt. It became a problem of public debt because we socialized most of the private debt. That private debt itself was in turn an outgrowth of an increasingly dysfunctional and overly financialized economy. And that's really where I think you have to start from. So I think it's wrong if we start talking about tackling fiscal challenges, we're looking at this the wrong way around. When we discuss financial reform, the focus invariably seems to be on the liability side of the bank's balance sheets. So, for example, as James pointed out earlier, we propose higher capital buffers to deal with a pre-existing problem. And that in itself is not a bad thing, but it means that we are not really responding to the activity which gave rise to the systemic problem in the first place. And the corollary, I think, also applies, which is to say that with the greater complexity in our financial system, which we continue to tolerate and indeed encourage, we try to counter that by introducing increasingly complex regulation. This is a problem which Andy Holding of the Bank of England, amongst others, has repeatedly cited. And what you really want, I think, is to move towards a simplified financial system, which means in turn that you'll have less cumbersome and more readily enforceable regulation, as well as avoiding the problem long ago cited by Hayek, which is that who regulates the regulators. So recognizing that what I'm about to suggest are perhaps politically unrealistic in the current context, I'm still going to suggest them because I think they are the right policies. I start from the proposition that the only useful thing that a bank should do is facilitate a payment system and provide loans to credit-worthy customers. I don't really think that investment banking per se has much of a socially useful purpose, and I say that as someone who was in the financial services industry for about 30 years, and of course people would say, well, of course you can say that now because you work for INET, but the reality was that I was making a lot of these same points when I was still in the dreaded industry. So. With that in mind, I will give some specific flesh on the bones. I believe that banks should only be allowed to lend directly to borrowers and then service and keep those loans on their own balance sheets. I don't believe there's any further public purpose served by selling loans or other financial assets to third parties, but there are, as we now know, substantial real costs to government regarding the regulation and supervision of these activities. And there are severe consequences for failure to adequately regulate and supervise these secondary market activities as well. So for that reason, banks, I believe, should be prohibited from engaging in any secondary market activity. The argument that these areas might be profitable for banks is not a reason to extend government-sponsored enterprises into this area. I mean, it's we also don't suggest that our banks do, say, medical services businesses just because they happen to be profitable. So I don't think profitability per se is a justified reason for allowing something. This is something I suggested a few years ago, considerably more controversial at the time, maybe less so now, which is that banks should not be allowed to contract in LIBOR. LIBOR, we all know many of the problems now, but it is an interest rate set in a foreign country, the UK, with a large, shall we say, subjective component that is out of the hands of most governments. And I think back in 2009, part of the problem that we had was that the Federal Reserve had an inability to bring down LIBOR settings to the targeted interest rate as it tried to assist millions of U.S. homeowners and other borrowers who had contracted with U.S. banks to pay interest based on LIBOR settings. And there was no real reason for it. Desperate to bring U.S. interest rates down for domestic borrowers, the Federal Reserve resorted to a very high-risk policy of advancing unlimited and functionally unsecured U.S. lines of credit called swap lines to foreign central banks. So in a sense, that's like, to me, that's like giving someone in Europe your watch to use and hoping that he gives it back to you in the same kind of condition, but having no means of enforcing collection if something goes wrong. To go back to another point, I think banks should not be allowed to have subsidiaries of any kind. Again, I don't think any public purpose is served by allowing banks to hold any assets off balance sheets. Banks, I believe, should not be allowed to accept financial assets as collateral for loans. Again, I don't see any public purpose is served by the use of such extensive financial leverage. This is more controversial and maybe runs against the trend towards the increasing internationalization of our banking system. I actually believe that banks should become much more national in scope. Regulation is much easier to manage. I don't believe that banks should be allowed to lend offshore. Jamie Dimon's point about if JP Morgan doesn't do it, then a Chinese bank is going to step in and offer the service. And my feeling is, well, that's good. Let the Chinese bank do it. It's a socially polluting activity if it goes too far, and let them deal with the consequences of that. There is really no need to go beyond national borders. And frankly, as regards to the U.S. in particular, I believe that the U.S. has considerable leverage in this area, and that which is to say that you can easily enforce your own laws and regulations by simply denying banks, foreign banks in particular, licenses to operate in your market if they don't adhere to your rules and regulations. In the 1990s, we banned Daiwa from the dealing in the U.S. bond markets because they violated our regulations. We don't really do that anymore. By the same token, banks should not be allowed to buy or sell credit default swaps or insurance. Again, I see no purpose in that. Banking is essentially a public-private partnership. It is the only industry I can think of where you are effectively underwriting the liabilities of the bank's balance sheet. So you are actually allowing and I think that the key should be to allow the private sector to price risk via credit analysis, which is what we used to do. What I have said repeatedly about credit default swaps is that they are to hedging credit what nuclear weapons are to hedging our defense requirements. It sounds great in theory, but if you start to use it, then it tends to screw everything up. And I think the last proposal related to that, and this applies to the US, but I think if there is an FDIC equivalent in other countries, but I would like to see banks utilize FDIC-approved credit models for evaluations of bank assets. The FDIC was one of the few institutions that covered itself with glory, I think, in the crisis. I think Sheila Bair herself had a very, very good crisis and really tried to do a lot more than she was allowed to do. By the same token, I would not allow banks to do mark-to-market of bank assets if we get out of the securitization business. There's no reason for it. If there is a valid argument to marking a particular bank asset to market prices, that means likely that the asset should not be a permissible bank asset in the first place. You want to have them holding the loans to maturity, and again, it makes it much easier to deal with the regulatory problems. And I think with that, I'll pass on to the next panelist. Thank you.
All right, next we have Eric Helleiner. Now, in the spirit of openness or transparency, Eric and I are originally paired, but for a variety of reasons, we couldn't write the background paper together, which is a shame for me because I'm sure it would have been a much better paper. But on the other hand, he doesn't have to agree with me. So I'll turn it over to Eric.
Thanks, Pierre. Pierre's being very polite. I just said I was a bit too busy, so I apologize for that in advance, but it's much easier to write 5 minutes of comments than to write the fantastic paper that Pierre wrote. We didn't coordinate our comments, but they really flow quite nicely from each other. James talked about the market problems. Marshall set out a set of proposals, and I want to talk about the governance response that actually happened since 2007, 2008. And set out maybe some provocative ideas about its limitations and what could be done at this moment. I don't want to talk about the content of the rules. There's an enormous amount written, thousands of hours of negotiations over bank capital, resolution regimes, hedge funds, credit rating, etc. You know the details. What's striking to someone like me who follows this is how little has been implemented and how little has been implemented on time. And so just to take the most immediate example, in 6 weeks' time, 3 of the initial initiatives are supposed to come into effect. So this is required CCPs, or clearinghouses for OTC derivatives. The first provisions in Basel III are supposed to come into effect on January 1st. And we're also supposed to have all living wills, they're so-called, for the globally systemically significant institutions. None of those 3 initiatives are coming in on time. Okay? And in some cases, a quite extreme divergence from the commitments that were made by governments. If you read the progress report, which the FSB put out in June, they have a kind of a traffic light system. It's very useful, but also extremely depressing. Very few green lights, a few red lights, complete inadequacy of action, a very large number of yellow lights or amber lights about, concerns about what's happening. The Financial Times ran a very interesting story recently with a quote that I found very striking from a senior executive of one of the world's largest banks who's involved in regulatory issues. And he said, "It's a bloody nightmare. The regulators have no respect for one another. Every country is looking after itself." Okay? That's the mood of people who are in the business of implementation of these regulations that the G20 and the FSB are working on. What's the problem? Well, at a core level, this is a soft law regime. In contrast to trade, where we have the WTO with all kinds of hard laws, the financial regulatory regime has never been hard law. It's always been based on voluntary compliance. This has long been a problem, so at the very moment we're trying to introduce Basel III, there's all kinds of members of the Basel Committee that never introduced Basel II. And so, and that was supposed to come in 2006. And so this is not a new issue, but it's been intensified by the scale of the regulatory issues that are being addressed in the wake of this particular crisis. I personally think it's been intensified by the diffusion of power within international regulatory affairs. We used to call the regime a voluntary one, but de facto there was a threat of denial of market access to countries that did not comply. Increasingly, that threat has been diffused. So you may be denied access to the US market, but there are other markets that you can go to. Or if you're from Brazil or China, you have your own markets that are increasing in their sophistication so that the threat of denial of access is less effective. I also think the scale of the network of regulators as it increases in size, the kind of peer pressure and consensus formation becomes more difficult to achieve. We know from a long body of political science literature that regulators have often complied because of a sense of their status within that network, but that status is increasingly less effective as a kind of compliance tool. So what do you do? Well, the FSB, now led by Governor Carney, I think is doing as much as it can within the soft law framework. So there's a kind of intensification, if you like, of soft law. Greater surveillance, the status reports, there's a new coordination framework, there's a strengthening of peer reviews, there's a strengthening of FSB governance itself. You know, everything that you could possibly do to push the limits of what soft law can do is being done. But it's not enough. And the obvious question, which strikes many people who've been following this, is why don't they take the next step of moving to a WTO-style model? And many people have made this argument over the years. Probably the most prominent is Barry Eichengreen, who proposed a kind of dispute settlement process, so non-compliant states would be subject to the sanctions of FSB members. There was a very striking moment to do this, and that was when the charter of the FSB, which was initially set up right after the crisis, was being revised at Los Cabos. And many of us were watching. What would they do about that? Well, this is the exact wording. The FSB considers a treaty-based intergovernmental organization not to be the appropriate legal form at this juncture. So again, deciding not to go towards a hard law solution. Why the resistance? I think you can anticipate the reasons. The level of detail that is being developed by FSB standards is so high, and this is the criticism that Andy Haldane and other people are making, that countries are very reluctant to sign up to commitments. One size fits all, as many people have argued over the years, is not the appropriate way to regulate. Pierre made that point, I think, very effectively in his paper. And the more detailed that the regulations have become at the international level, the less you want to commit to them. They're too inflexible. They may not be appropriate for your local conditions. You may be converging on the wrong standards. There's all kinds of risks. So what are countries doing? They're acting increasingly unilaterally. If you cannot trust the international regime, because people aren't necessarily complying with it, you must look after your own interests. And this goes to a point that Nari raised in the first session, which is a kind of a nationalization of financial systems. And so you see this with the CCP debate, where every country wants their own clearinghouse, which is really increasing segmentation of the global financial system. You see it with the resolution regimes. Even the implementation of living wills has this effect of segmenting the financial system. Capital account management that Jose Antonio talked about last night. A greater emphasis on host country regulation, forcing banks to establish subsidiaries. Now, these things are not necessarily bad. There are some efficiency costs as you move towards greater segmentation, but it does increase safety. It increases your insulation from the mistakes of poor regulation abroad. In my mind, though, and this is what I want to finish up with, we're missing one piece of the puzzle. I mean, you can have an increasing push towards greater host country regulation, but it's ultimately not going to be fully effective without some degree of cooperation with foreign regulators. And this is where I think the FSB is at a real turning point. Does it continue to try to enforce detailed harmonization, which nobody wants to sign up to? Or could it become a treaty-based organization which was in the business of enforcing much more limited, simple, principle-based international standards? My own sense is countries might be willing to sign up to a much more Haldane-style form of regulation than Basel III. And in that sense, I think the FSB has a moment to say, yes, coordination in a very limited degree is important. Cooperation, research sharing, information sharing, all those things, early warning exercises are fantastic. But we shouldn't be doing much more than that. But if we limit our ambitions, we may actually get people to commit to these things in a serious way.
Thanks, Eric. So lastly, we have, and I hope I pronounce your first name correctly, Sang-Chi Lee from the Financial Services Commission of Korea.
Thank you, Pierre. First of all, I'd like to join others and thank CIGI and other event organizers for a generous invitation. And I'm very much honored to be here to participate in this panel discussion at this conference. The background discussion paper for session 2 by Pierre was very good and insightful based on wisdom and experience, and I very enjoy reading it. I do pretty much agree with him, all his observations, except a few points. And since I'm given about 5 minutes in this first round of comments, I'd like to add one quick remark on the efforts to establish an international single set of acceptable standards, which Pierre said unlikely and unreasonable, and also Eric mentioned about it, one size doesn't fit all. But I'm not sure if it is desirable and feasible to apply differentiated regulations to different countries. There will be certainly pros and cons for this approach. In fact, the question that the international standards should be adopted and implemented by all countries was the very first topic in one of the Financial Stability Board Task Force report to G20 leaders on financial stability issues in emerging market and developing economies last year. And I've chaired the task force, and FSB members, including the IMF and World Bank, have participated along with the senior policymakers from some emerging market and developing economy outside the FSB. It is true that because each nation faces different circumstances and conditions, the national regulatory and supervisory measures for financial products, markets, and intermediaries would be different from country to country. But on the other hand, this creates challenges such as regulatory gap and arbitrage, or may lead to the issue of extraterritoriality. This in turn causes another problem because in this integrated global financial world, money and investment will freely flow from one place to another, looking for gaps and arbitrage. The conclusion of task force report is that global finance requires a single framework of well thought out global rules, which is comprehensive, complete, and presents no contradictions. And the first goal of global cross-border supervisory cooperation should be to define such a common framework. FRB Chairman Ben Bernanke also mentioned in his speech that the goals or objectives of global coordination in financial regulation include, number one, maintaining the level competitive playing field across countries. Number two, minimizing opportunities for multinational firms to take advantage of weaker or inconsistent regulation in some jurisdictions. Number three, establishing consistent and complementary standards. And number four, and ensuring effective oversight of internationally active firms and markets. International standard-setting bodies such as BIS, IOSCA, IAIS, and FSB have undertaken substantial work, countless discussions and meetings in preparing many core principles on banking, securities, and insurance regulation, even before the global crisis that are internationally consistent. The objective of these core principles are to introduce at least a minimum of regulatory controls. So it would be the starting point for international standards for financial regulations. And remember that the international standards remain flexible and evolve over time to incorporate new country experience, empirical evidence, and analytical insights. So instead of applying differentiated standards to different countries, I think it would be better to apply the standard to all countries, with one caveat though, that the adoption of such standards would need to proceed at a pace consistent with the country's supervisory capacity and level of financial system development, considering the impacts on the economy. Namely, they need to be well planned, timed, and sequenced. These two approaches may sound the same, but in fact have very different policy implications. And regarding the comment by Eric, why you're going to question why then some members or other jurisdictions are reluctant to adopt the international standards, or if it's a minimum, is related to the structure of FSB representation, I think. In Los Cabos last June, leaders of G20 called on the FSB to continue to keep under review the structure of its representation. The purpose of its declaration is to reaffirm that the current representation structure needs to be further improved, and this is an important task for the FSB. The core issue surrounding the current FSB representation structure is the differential seat assignments for member jurisdictions at the plenary and the steering committee. Many G20 member countries have raised questions regarding this matter on various grounds. Even though FSB adopts the consensus-based decision-making process, it takes differential approach to seat assignment, which makes it difficult to reach a true consensus. Seats are assigned, as you know, based on the size of national economy and financial activity, but there is no specific formula agreed by the entire membership. In that sense, the credibility and transparency of the current FSB's representation structure cannot be ensured. Furthermore, under the current structure, decision-making process tends to flow in favor of member jurisdictions with higher representation, and this could hamper the full and consistent implementation of financial regulations at the global level. Emerging market and developing economies are continuously emphasizing the necessity of discussion on financial regulation from the regulation from the perspective of EMDEs. What does that imply? It implies that EMD feel underrepresented within the Financial Stability Board. So I believe it is worth being promoted as a key agenda of the FSB from now on, setting a separate working group and a detailed timeline. Thank you.
Thanks very much. So I thought I would start the conversation by picking a particular point that each of the panelists raised, and then ask the other panelists if they wish to respond. Please keep it short, and if you can, and don't feel the need to respond to every particular question. So I'll start with James, if I might. You talked about the dilemma facing central banks, and essentially in this crisis, central banks, to put it as Bernanke did whatever it took to respond. But under the surface, some of the major central banks actually responded quite differently. So you have the Bank of England, which indemnified itself with an agreement with the government to protect itself against losses. In the US, in theory, the same thing happened, but it's not entirely clear whether they're actually indemnified against losses. And then you have the ECB, which has this outright monetary transactions, which has this conditionality requirement. I'm just curious whether you would like to comment on these different responses and what it implies for global financial regulation.
I guess, Pierre, to each their own, and I think there may be a consensus in the room that the Europeans have a unique way of viewing financial crisis. But the key thing is they're all converging on one thing, which is promises of open-ended liquidity. It could be conditional in the context of the ECB. It could be funding for lending in the context of the Bank of England, which may just work, but obviously takes the Bank of England very deep into the credit allocation mechanism to the economy. Or in the case of the United States, making an open-ended commitment based on economic variables, which is bold. So yes, there's style differences, but they're all heading in the same way, and that would appear to be zero interest rates being a semi-permanent fixture of our financial landscape, which, by the way, incentivizes nobody to deal with the underlying problems of this crisis. Take the fiscal cliff. Now, we can argue about it and worry about it quite rightly, but as long as interest rates remain low, as long as the Federal Reserve is out there buying a certain amount of treasuries or agency mortgage-backed securities or whatever, there's really no incentive for anyone in Congress to deal with the underlying fiscal problem. And it's the same in the Eurozone. And to be fair to Draghi, who's a very, very capable man, and he has been unquestionably a force for good since he became president of the ECB, a lot of which involved undoing the damage of his predecessor. But he's a force for good. And he has given this conditional commitment to put the European Central Bank's balance sheet on the line in order to save the Eurozone. But at the same time, spreads have tightened so much because he's such a credible central bank president, in the case of the ECB, not governor, president. Spreads have tightened so much that all the pressure is now off Rajoy to actually sign up for a bailout. So we're kind of in this unstable equilibrium. But that's not really what you're asking, but I think the key thing is they're all in the same spot. It's just a question of how they actually get there. And their balance sheets are going to be heavily involved in stabilising the financial system for a long time to come. If I may just switch briefly to something Eric raised. There are many good points that Eric made, but one in particular is about living wills. And I can understand why regulators and supervisors would require banks to write living wills. In other words, how will we deconstruct you if you run into trouble without resorting to taxpayer money and so on and so forth to bail you out? I would think that a far more useful exercise would not be to have banks write living wills on themselves, but to have banks write a living will of their 5 biggest OTC derivative counterparties. And the reason is twofold. A, if bank management has written a living will that needs to be exercised, the chances are very high that they had no idea how their bank worked. And as such, will be anything that they have put together, I reckon, would be utterly useless if it's needed. And by asking the world's 5 biggest derivative banks, for example, or anyone we choose, to write a living will of their 5 biggest OTC derivative counterparties, you get an instant read on how badly risk technology across the financial system has kept up with the evolution of the financial system, leverage maturity transformation on a bed of hot money. And you'll also find out how people manage counterparty risk. And inadequate management of counterparty risk is how you get spillover effects from financial crises. In terms of central counterparties, very briefly, they are widely perceived to be a panacea. For a number of technical reasons, they will not be. If there were CCPs in existence in 2007 and 2008, AIG would still have happened. And I think people need to keep that in mind. Perhaps we could talk about that later, but I'll hand over.
Anyone else care to quickly pick up on any of these points? No? The next question I would have is relates to Marshall's presentation. You talked about the difference between, I guess, narrow banking and investment banking. You didn't specifically mention it, but I gather you have something in mind relating to the Volcker rule versus the sort of the ring fencing type of approach to dealing with financial regulation. I was wondering if you could talk a little bit more about that and whether you have an opinion about whether there's substantive differences between the two approaches, whether one is preferable or not.
Yeah, I mean, I'm generally sympathetic to the Volcker rule. I think, people say that it wasn't the banks, the larger banks, that caused the problems last time. That it was it was Lehman Brothers. But I do actually think that it goes to the broader point I was making, which is that you shouldn't be speculating with other with depositors' money. Look. I'm not trying to say you should ban investment banking because it's unlikely to happen. I think the challenge is that let these guys play in their own little sandbox, and if they blow up, then let them blow up. I mean, that's the key. But I don't want I want a credit system based on credit intermediation. I want bankers to have customers, not counterparties. And I don't really see an advantage for the most part to a market-based system of finance. And here's the reason why the shift to markets and banks matters. When you have a commercial bank and it makes a loan, at least in the old days, the loan officer's first question was, how will I get repaid? The loan is illiquid, you hold it to maturity, and so what you think about, what you're concerned about is the ability to repay that matters. It's the most prudent way, is to rely on income flows rather than potential seizure, like we've got now with these horrible little mortgage problems we have in the US, and the forced asset sale of the home at some point in the distant future. Now, on the other hand, when you have an investment bank and it makes a loan and it's securitized, his question is, how will I sell this asset? That's going to be his big question. So the future to him only matters to the degree that he has the value of the asset today and can he sell it immediately. So he doesn't have to worry about the distant future because once he's got it off its book, it's no longer his problem. Now, of course, when times are buoyant and it's wonderful, you can sell assets that are whose values are disproportionately determined by expected asset appreciation, and you get this bubble dynamic that works in a very, very positive way. And at that point, the sky's the limit. But you know, obviously, when it goes in reverse, as it did in 2008 and 2009, then you have got a tremendous systemic problem on your hands, and that's what I'd like to get us away from.
Thank you. Eric, you mentioned the FSB is not a treaty-based organization, which is something I also talk about. But I wonder if one of the other reasons maybe where we're at today is because maybe the policymakers did some sober second thinking, and maybe the original plans they had maybe are not the ideal ones. Could that be another reason why we're where we are?
It's possible, but they're still spending thousands of hours negotiating. And so there looks to be commitment. I think the point that CIGI made is really a fascinating one, that one of the biggest problems that the FSF had, which was, for those of you who aren't familiar, that was the predecessor to the FSB, existed for 10 years after the Asian crisis. And incidentally, if I can do an advertisement, we've had Paul Bluestein has done a wonderful paper about the history of the FSF for CIGI that you should all have a look at. It's really interesting. One of the problems that the FSF had was exactly the point that CIGI has made, which is that the FSF had extremely narrow membership, G7 plus a few others. And the aim of its targets was everyone else. It was poorer countries. And so those poorer countries rightly said, why should we adopt standards that we had no say in creating? And many of us hoped that the FSB's creation would address that problem in the sense that the FSB's membership became more inclusive of all of the G20 plus, again, some others. But as Senji points out, this still is a source of contention for a number of the emerging market countries within the FSB. They have been assigned fewer seats in many cases, and they're not well represented on the steering committee. And their voices in general, and this has come through in a couple of the G20 statements, are not coming through in the detailed content of the FSB's recommendations. So we still have some way, it sounds like, to go, but the principle remains the same. You know, people will not adopt things that they don't have a say in creating. And that, I guess, gets to Jose Antonio's central point last night, that you must have accountability to have effectiveness.
Thanks. Actually, that's the question I had for Sanchi, which is you talk about the desirability of a single framework, but I wondered, can you speak to where does accountability rest when the framework is not followed or global supervision is not effective?
Yeah, yesterday the Jose Campo mentioned about it is a large membership, but it's like G2 or G4 or something like that. I think legitimacy, accountability related to legitimacy, which is also related to representation in the organization. And of course, when you expand the membership, the efficiency or effectiveness of decision making has to deteriorate. But to secure the legitimacy, which is, I think, the equal representation is very important to get the accountability, to secure the accountability, and to get secure the legitimacy.
All right, thanks. Well, all of you see the slide there, And so we're open for questions, and please address your questions to either the entire panel or specific panelists. And I see there are 2 questions from table 6, and then followed by, I see, as far as I can tell, 1 question from table 2. So we'll start with table 6.
Hi, I'm Jo Marie Griesgraber with New Rules for Global Finance in Washington. And we do work considerably on the Financial Stability Board, and I'd like to, first of all, compliment Mr. Lee for his leadership of the October 20th paper of last year, which did include developing countries, and it addressed financial regulation, or rather regulation of banks, from the perspective of developing countries, because you had some very excellent minds, excellent people participating in the writing of that paper. I would say in contrast, you might want to look at the paper that was written at the time of Los Cabos on unexpected consequences of FSB regulation as a really suboptimal, not to say crappy paper, because it had no perspective from developing countries in it. I mean, the contrast between those 2 papers is stunning. I would like to note that in terms of representation, there are a lot of countries that don't belong to the FSB, and they're still expected to take the regulations, to implement them. So you have the non-members still, and that's the majority of the nation states of the planet. There is an effort by the FSB at regulation, or inclusion through the regional consultative groups. But even that is absolutely not transparent, unrepresentative. You don't know who's invited in. We fought and raised a ruckus, so now both the G20 co-chair and the G20 non-co-chair can participate in the FSB plenaries, but the non-co-chair has to be only an observer. Why? Why this exclusion of those who are supposed to take rules? And then I worry about the countries who aren't even allowed into the regional consultative groups. So I think there's a real serious problem of inclusion, representation, legitimacy, effectiveness of the FSB. I also want to just briefly say that I think that Marshall's comments on the role of banking is just stunningly brilliant. If you want simplicity and effectiveness, I think he nailed it. Thank you.
Thank you. Did you want to respond, since you were...
I'd like to thank for the wonderful comments. Thank you.
There was another question from table 2.
2 more. I mean, 2 questions from me, and there is somebody else from table 2. I have a question for the chair and a question for the plumber. The question for the chair is, you distinguished monetary stability as being forward-looking and defined financial stability as being backward-looking. Certainly, to a first degree, you could see that, but as all the issues of counterparty risk and valuation of what the assets are that at the moment in time are in the balance sheets, that really makes it forward-looking as well, but in a very unpredictable way, because counterparty risks are very hard to analyze systematically. And I thought that the suggestion of asking the main OTC derivatives centers to give what their living wills would be, that seemed very nice. So that would be my question to the plumber. How would he do that? And the insight that you have no longer a safe asset. That's academic literature mentioned this way back, but nobody took it seriously. And right now, he pointed out that this was the main reason for worry. So again, I'd like some clarification on that. Thanks. The plumber, of course, I'm sorry, maybe everybody read the, yeah, right.
All right. As the chair, I'll very briefly respond. I did not, if I did, I was unclear. I did not define financial stability as backward-looking. What I thought I was trying to say is that the application of financial stability so far has tended to be backward-looking.
Okay. Yeah. So how do we go about getting the top 10 largest financial institutions, SIFIs, whatever we want to call them, to write living wills of their biggest counterparties? They've already done them. They've already done them, and they do it every day, because that's how they keep alive, particularly when they're thinking about OTC derivative counterparties in the Eurozone. Now, it's very complicated because you need extraordinary risk technology. There's very, very few financial institutions in the world where the CEO, the board, the CFO, the chief risk officer, and so on, can sit in a room, in a boardroom, and put up on a computer screen one QSIP, one bond identifier, and they hit a button, and it says exactly what the net and gross exposure is across, say, Goldman Sachs, in every subsidiary, and crucially, how it's funded. How do we get that exposure? Do we own it outright? Did someone pledge it to us on a repo transaction? How have we got it? And of course, if we're putting that QSIP in, we're worried about it, so we can eliminate the counterparty risk or the credit exposure. And of course, counterparty exposure from OTC derivatives is a very close cousin of credit risk, of course. And then there's issues like, is it collateralized or uncollateralized exposure? There's documentation issues, like we can talk about that bilaterally if you wish. But the banks do it every day. They've just never been asked. And I think it'd be a very useful exercise for financial supervisors and regulators around the world because, again, my sense would be the reason you get these spillover effects is because the entire financial system is trying to simultaneously manage down their counterparty exposure subject to headline risk. And again, when we talk about lender of last resort and how these positions are funded, hot money, tri-party, money market funds, and so forth, it's very difficult for any central bank to mitigate that. And we saw during the crisis the extraordinary lengths to which the Bernanke Fed went to stabilize the financial system. And just on this note, it's all related, on this note, they exhausted every form of secured funding they could provide to the financial system. And then they realized they had no choice but to provide unsecured funding, meaning buying an awful lot of assets and putting them on their balance sheet. Effectively, the financial system ran out of collateral in the fourth quarter of 2008. Maybe that's something we come back to later. But the brief answer is the banks do it every day because that's what keeps them alive.
All right, thanks. Was there one more question? Please keep it brief because there's 5 other tables and then I'll stop it. Thanks.
Yes. I just wanted to pick up on the theme that I struck before, Pierre, and that I talked to you about last night, is I think that I would assert that it's more likely in this whole theme of financial regulatory reform that the world, and especially the G20 world, will under-regulate than over-regulate. Now, there's a legitimate fear about over-regulation, stifling growth and the recovery and so on. But that shouldn't intimidate us from insisting that the under-regulation outcome doesn't occur. So what I would say is that it's not so much about regulation that we in the think tank community should be concerned about, but the monitoring and evaluation levels going on within countries about their own regulatory weaknesses and supervisory and oversight weaknesses, and that we could consider, as perilous as it is, putting ourselves in the role of monitoring and evaluating the monitoring and evaluation efforts going on in major countries. Because I think that if it's widely accepted here, which it may not be, that under-regulation is the more likely outcome, that we are implicitly complicit if we know that and we don't somehow figure out a way to hold the monitors and the evaluators to account that they're doing a sufficiently large job, effective job, to expose weaknesses in national financial systems and systemically important countries to fill the gap before it causes a collapse. So I think this, as compared to the previous topic of macroeconomic rebalancing, where I think all of our think tanks have much more capacity than we do in evaluating financial regulatory reform, I think if you accept both my premise and the implicit complicity that attaches to it, puts us in a very difficult position because we at Brookings don't have a lot of horses in our barn to do this. I'm not sure that CIGI does either. I'm not sure whether the rest of you do either. What do we do then? I'm not sure, but I think we should at least discuss it, talk about it, think about it, and be aware that we're implicitly complicit if we don't figure out an answer for ourselves. Thank you.
All right, actually, I was going to ask Eric whether you want to address it briefly. Thanks.
Sure. You know, to me, there's two different issues that think tanks can contribute on this particular issue. I mean, you can have people who are in the weeds of the details of CCPs and all kinds of things that are very difficult to understand. But, you know, what's CIGI's mandate, for example, is governance innovation. And one of the central problems that the FSB faces is a governance problem, you know, and it's a political, how do you organize the politics of coordination? And I think think tanks have a lot to say about that, and they often do comparative work, you know, across how have governance problems been solved in other areas, you know, what can the FSB learn? I think the other thing that I would add is that it's not enough to focus exclusively on is each country, you know, implementing at home to avoid the underregulation problem, which I agree with you, Colin, is a very serious one, because the lack of coordination is what contributes to that, because every financial institution in their own country will say competitive pressures, you know, are what means we can't have tight regulation. And so you must have some ratcheting up in a coordinated way, in my view, very simple rules, but still rules that are ratcheting up in order to prevent the competitive pressures from preventing regulation.
All right, thanks. We'll move on to table 2. Again, keep your question short. Fred Kunz tells me as a weapon to use in case I go over too long, so. Table 2?
Yes. So is this on? Okay, great. Thank you so much. This is a question to James. I really appreciate the very candid question that you had at the very start, because it's something that I think many of us have really wondered how much knowledge is there really about the system. And I appreciate you calling yourself the plumber, because the analogy that I always think of is the international financial system is the pipes. And we're all trying to renovate an old home, and if you're like me, addicted to these renovation shows, you know that you don't want to be poking holes all throughout a building to try and figure out where the leaky pipe is. And that makes me wonder, and I'm going to be here a little controversial, to say that have we, in the case of the Eurozone, for example, really deferred the adjustment cost on people and basically made this a debt crisis, when in fact this really is about banking. I mean, it's no coincidence that it's Germany and France, who are the banking centers of Europe, that are deferring the social costs of this adjustment on the people of Spain, Italy, Greece, and Portugal, when it's about leaky pipes, when it's about a banking structural problem that needs to be fixed. And I think that goes to, you know, if I can, you know, say as a comment to Marshall, I mean, that's where I think the great work of INET and others and think tanks can come in, because we need a mapping exercise of those pipes. We need to know what's behind the walls before we start poking, and before we, you know, not to take the analogy too far with the plumbing, but we all know what happens when you have bad plumbing. We don't want this all to sort of, you know, flow out in other countries, which are now, you know, really paying the cost of trying to fix the system. Thank you.
James.
Thank you very much for those kind remarks. I agree. Let's talk about the Eurozone first. I think it was inevitable we'd end up there, but let's talk about it. The European crisis is what you get when policymakers are ideologically opposed to, I won't say full-blown capitalism, but ideologically opposed to listening to what the financial markets are telling them. And there's a very simple question that Eurozone policymakers have never asked as we approach year 4 of this crisis in the Eurozone, and that is this: what do we need to do to incentivize long-term private sector, conservative, buy and hold, credit and fixed income investors to return to peripheral credits with confidence? What do we need to do in Greece to get their debt to GDP ratio down to, shockingly, well below the old Maastricht ceiling, which is now a floor, which might incentivize people to commit capital not just to peripheral credits, but also the banks? Your point about poking holes in the plumbing is a good one. Effectively, that's what the Europeans have been doing for 3 years, and until the arrival of a very highly skilled, pragmatic central bank president in the shape of Mario Draghi, who cut his teeth in the Italian debt crisis in the early 1990s and had to learn the hard way how a financial system worked. Until Draghi arrived, nothing was improving. It's not just the Eurozone, though, and I don't mean to pick on them, it's just that it's awfully complicated there. Is it a banking crisis? Is it a sovereign debt crisis? Is it a counterparty crisis? It's all of the above, and it's very hard to distinguish. In terms of the global scene, we have top-down dictated timetables for reforming the financial system. For example, by the end of this year, all OTC derivatives that can be centrally cleared you have mandatory central clearing for OTC derivatives from the end of this year. Now that's easier said than done. People thought, oh, they'd all have time to adjust and come up with high-grade collateral and cash and retool their risk management systems. There's a lot of people going to be caught out by this. The reason I asked the question at the start is not to put anyone on the spot, but just to make us think about how hard this is. It's really difficult. And if there's one great thing the FSB has achieved, it's an educational role. And if you go to the FSB's website and look at all their reports and summaries and so on, it's actually really helpful stuff. It won't tell you the answers, but it asks a lot of the right questions. My concern is that as the timetable becomes more and more ambitious, or should I say more immediate, that we still know very, very little about how this financial system works. Now, it's all very well for a chairman of the Federal Reserve to say, I'm expanding my balance sheet, I'm learning by doing, I'm targeting unemployment. That's one thing. That's one thing. But to stabilize our financial system, leverage maturity transformation on a bed of hot money, stabilizing that is awfully, awfully difficult. And I think we need a tiny bit more time. We don't abandon it, but we need somehow a time out to say, actually, what does all this mean? And I'll just end with one particular example. As a result of new requirements for central counterparties, initial margin, segregated accounts, so on and so forth, the financial system collectively will need to come up with an enormous amount of high-grade collateral which will be locked away in segregated accounts, liquidity buffers, so on and so forth. No one actually knows how much. The International Swaps Dealers Association suggests that the figure is 15.7 trillion, with a T. The Bank of England thinks it's 800 billion. Bank of New York, which obviously hoped to be in the middle of all this collateral management, think it's somewhere between 2 and 4 trillion. Nobody knows. And the reason I raise that is because we have a timetable that has to be met over the next 6 months. And nobody knows what the actual impact is on the system, how people will come up with that high-grade collateral, and et cetera. So I think you're definitely onto something.
Oh, I'm sorry. Very quickly.
Just to add, I mean, the other problem too is that, you know, the private sector is like the old homeowner that has the blueprints that doesn't want to give it to you. I mean, this is what we're not talking about, is that we have a private sector of financial interests that don't want to share how the piping is behind the wall.
Yes. JP Morgan has 5,183 subsidiaries around the world. Jamie Dimon got so far by waking up in the middle of the night saying, I must ask about this, I must ask about that. Mm-hmm. And then he got caught by the London whale because their systems did not know what they had. Exactly. You're absolutely right.
All right, this reminds me that Jim Haley in the morning talked about rules being useful, but they can bite you. One of the things we haven't talked about is there's regulation and reform, but the sequencing matters. So what do the Europeans do? They revise their Stability and Growth Pact, which has been largely forgotten now, and the problems are the ones that you raise, which is the ones that they failed to deal with. So let's move on then to Table 5, and please keep your question or remarks short, please.
My question concerns the influence of new regulation, both actual regulation and possible regulation, on international capital flows. It's not a secret that many countries around the world lack resources for development. And the high level of debt of government debt in many countries leads to the situation when governments don't have resources for investment, and they want to attract investment from abroad. But the risk appetite is also very low. And in this situation, I think that we must find the balance between risks and efficiency of international financial systems. I've heard the ideas to limit investment banking, to limit the use of collateral, and so on and so forth. Of course, we can make risks low, and the least risky operation is not to give loans at all. But in this situation, the resources for development will be limited. And I'd like the panelists to comment on this balance between risks and efficiency.
Well, personally, again, reinforcing my Luddite views here, I actually think that we've probably gone too far as capital liberalization goes, and I actually do support things like financial transactions taxes, which I think would, if nothing else, add a bit of friction to the system, and I'd like to see, so things slow down. And I think that could also be helped by getting rid of a lot of the loopholes that the banks have, particularly in the U.S. in regard to some of the, I think it's section 133 of the 142 of the 1933 legislation from the SEC, which effectively exempts investment banks from their fiduciary responsibilities. If they had a little bit, if the fiduciary role was enforced a little bit longer, it may not change the nature of the products that it's introduced, but it would actually slow down the pace at which they're introduced, and that might have helped things along. So,
I think Eric had a brief.
Sure, just very quickly, your point is extremely well taken. I mean, the pressure to be building up capital at home and to meet the margin requirements, all these various things, is causing a pullback of funds. And this is particularly hurtful to countries who were encouraged over the previous 15 years to open up their banking systems to foreign banks. The foreign banks, like in Mexico, are controlling much of the system, and now to meet requirements at home, they're pulling funds home. So you may have seen Guillermo Ortiz saying, this is why we need host country regulation, to force Western banks who have a branch in Mexico to become a fully capitalized subsidiary that's controlled by Mexican rules. So that, to me, is reinforcing this segmentation of financial markets, which, again, I don't necessarily think is a bad thing, but it is a different world.
I think that's spot on, and it's a great point you raise, and I think what we don't know, or we suspect it's a large number, but what we don't know is how much of the cross-border funding to developing economies is provided by large, systemically important financial institutions. How do they do it? Does it come out of a central treasury in their home country? Is it funded domestically via subsidiaries? We don't actually know. Before we say, I disagree with Marshall saying, we should shut down this, shut down that, that's great. But we have a measurement problem. We don't actually know what that means yet, although we've seen a real-time experiment in it within the Eurozone, where it is every bank for himself up until a few months ago. With ramifications for Eastern Europe, obviously, that we need to be alert to. So I think we need to try and measure the cross-border flow. The BIS has done a great job on that, but obviously the statistics only give us a retrospective snapshot of cross-border flow without telling us why it might be occurring. So I think more work needs to be done to understand why the capital is moving as it is. And the last quick point I'll make, in a world where more and more Western Hemisphere central banks are not only taking rates down but keeping them there for the foreseeable future, investors are incentivized to divert more and more of their portfolios to developing markets, which would seem to be at cross purposes with the idea that we should impose capital controls and prevent the money coming in. So I'll just leave it there.
Next we have table 3.
It's Mike Callahan here from Australia, and I have a question to Eric, and it's the practicalities of moving where we are now within the FSB, where countries are signing up to standards, agreed standards, through the standard-setting bodies, etc., which, yes, it's soft law in terms of how they're going to be enforcing compliance of them, to a world where you have a treaty-based FSB, which is a simpler set of rules which countries will sign up to in hard law, where there will be sanctions to implement. two problems with that seems to be you're sending a signal that everything else is really, you don't have to comply with it. And what would the countries be prepared to agree with, which would be the hard law, might be so difficult, so limited, or so motherhoody that you wonder how effective it would be. The other element in terms of this soft law is, have we given it time? In the sense of the peer reviews, etc., it's really just starting. And this is something that Governor Carney has said within the FSB. He does believe you've got to give it time. But the one other comment I'd make about a problem, and which has come up now, which people are saying we're only 6 weeks away to when we had a deadline for the changes on OTC trading, moving to CCPs, etc. I think the biggest problem was that commitments were made to those deadlines and no one had the faintest idea what they were dealing with. And the problem with that is it was the political pressure within the G20 to have a signal of credibility that we've got to have a deadline. And we've had lots of deadlines implemented where no one went into any degree of, no one knew what they were doing and the magnitude of it afterward, after the event. In some respects, not signing up to those deadlines may be the sort of not implementing or not meeting those deadlines may be the best thing out, because there still needs to be time to work out the full dimensions of what's happening.
Can I add to that question? And also to talk a bit, I'm Danny Bradlow from the University of Pretoria, an American university, to ask about the realism of turning the FSB into a treaty-based organization. Because if it were to be a treaty-based organization, it would be a treaty signed by states. But the participants in the FSB are regulators, and not all of them are necessarily working for the state, depending on the institutions and the regulatory structures in the different countries. Number one. The other problem is that some of the necessary participants are the international standard-setting bodies, which are not international organizations, and so can't really sign up to a treaty. So how do you actually create a treaty-based organization out of this mix? Is question one. And if I can add a second question on another topic to that is, we've talked a lot about the global level and the FSB and about national regulations, and I'm wondering if there isn't space in there for regional equivalents to the FSB, which maybe can be more appropriate to local circumstances.
Pierre's told me to say very little because we have no time. So, but these are excellent questions. In terms of the practicality, on Danny's point, you could have people sign up to hard law in the standard itself. It's not that the FSB as an institution necessarily becomes a WTO equivalent. So Eichengreen's proposals, you have these standards that are hard law, but the FSB has a DSM procedure which enforces them. So I think that actually gets around the legal issue that you're worried about. I think the more serious critique from my standpoint is the ones that you're suggesting. I mean, I think there are some things that are important, even though they're minimal. So the leverage ratio. Principles that everybody do something about SIFIs. You know, is a general principle, but it's not clear that's going to be followed out in the soft law mechanism. The implementation of CCPs, despite all the problems James is correctly highlighting, it's an important initiative, so you require people to do that, and then you have some enforcement mechanism. What I'm nervous about, and why I think countries won't sign up, is when they get into the level of detail of Basel II or Basel III. And that's where the inflexibility, the often inappropriateness of the concerns, and especially the incompatibility of detailed rules with macroprudential philosophy, which requires discretion. You know, that's at the core of what macroprudential philosophy should be. That's another reason for making it minimal but substantive in terms of everybody must do something about X problem, and making that hard law.
All right, thanks, Eric. Next we have table 9.
Thank you. Eric, I think it was mentioned Andy Haldane's paper, which was rather intriguingly titled The Dog and the Frisbee. And he drew the implication that this is a way of moving towards the FSB being a principles-based treaty organization on the basis of much simpler rules. Another element of Andy's paper, as I read it, was that not only are the complex rules self-defeating, you've got an arms race between the financial markets developing instruments which are ever more complex, and the regulators who have to catch up. But he also said that actually moving to simpler forms of regulation, simple leverage ratios, whatever, and also market-based indicators is actually more efficient for the regulator or supervisor. I'd be interested in the panel's views on that, and if they agree with it, what are the implications for both the national supervisors and the architecture?
Okay, I was listening. And regarding this FSB structure, whether it's treaty-based organization is better or is its current form is better, I think there is a special a working group called SCSI, because the Steering Committee on Standard Implementation Group. It's studying a lot of options. One is not the treaty basis, but not the current form. It's in between. It's like FATF, the money laundering organization. It's not treaty-based organization, but it has strong enforcement power through peer pressure, or there's a penalty on in bilateral transactions. So maybe it's one option to go follow these FATF examples. And regarding those, the rulemaking, whether this market-based indicator is good or not, when we talk about these CIGI surcharges, there's a lot of discussion on the bail-inable debt, and whether we should allow those bail-inable debt in satisfying the surcharge. But the conclusion is that market, even if it's market indicator, it has certain problems. So until we clear those concerns, and we cannot use these market indicators. The one reason is that market indicators also, what do you say, the cyclical. It depends on the market conditions and the abrupt changes in market conditions. So it is judgment. You need the judgment call to use it as some basis for your action, and also I don't remember. There's many issues, but also market indicator also has its own problem, and the regulatory the standard also its own problem. So we'll go on studying those concerns, and a lot of working groups are working on that. Thank you.
All right, we move on next to table 4.
Yes, I have a question, but I mean it has been partially addressed. But about the table did speak very little about the capital account regulation issues, and from the governance point of view, the fact that there is sort of a decision that the FSB will doesn't consider cross-border capital flows as a form of finance, so everything should be regulated except, I guess, capital flows. Now, so is this a correct arrangement? And I have always found a bit peculiar the point of view of the chair that everything should be regulated in finance except cross-border capital. I mean, isn't cross-border capital flows some part of finance that should be subject to some regulation? And I guess I also disagree with his initial point that the research of recent years shows that it's totally ineffective. I actually thought that a lot of the work by the IMF in recent years has actually shown that it's quite effective. That countries that actually use it can actually reduce financial risk. So I just wanted to some of the members of the panel to reflect on this.
Well, I'll let others go first. I'll go last.
Yeah, I remember, Jose Antonio, you making this point in the high-level FSB panel also about the need to for the FSB to address cross-border. And I think the case is even stronger given that even within the charter of the FSB, the mandate to address macroprudential is there. You know, it's in very early on in the FSB charter, and capital account regulation is a macroprudential tool, and so it is a striking absence.
Well, I'll just say that add to that. I totally agree that if you look back in the mid-1990s, we used to take the capital account regulation very, very seriously, and after the Asian financial crisis, which was arguably caused by the substantial deregulation of capital controls which the Asian countries had, there was this extraordinary expansion, mission creep on the part of the International Monetary Fund, and it started enforcing capital account deregulation. And this was never part of its original charter under the Bretton Woods agreements, and this has subsequently been imposed in WTO rules, and there's no real reason for it, and it has been highly disadvantageous for the developing world.
Well, let me just say that I said that when it comes to capital controls, that there are examples of where it's been found to be useful, but not universally so. And when it comes to IMF research, they sometimes reach one set of conclusions and then later on change their minds quite dramatically. But let's not forget that the same governments and institutions that introduced these controls are the same ones who implemented other inappropriate policies. So it's hard to imagine why you would be good at capital controls if you can't be good at something else. So that was the point I was raising. Not that they're always bad, but that there's certainly far from any consensus that capital controls are always and everywhere useful or helpful. So thanks to all the panelists for being on time. I'm going to allow each panelist a minute for their closing arguments, and then we'll proceed with lunch. We'll proceed in the same alphabetical order.
For the sake of brevity, I think Mike Callahan summed it up beautifully. And that is that 3 years ago, well, I think it was 3 years ago in Pittsburgh, G20 leaders committed to a series of guidelines for financial system reform without knowing exactly what they meant. And we need to be very careful over the next 6 months as all these new regulations come into effect. Because as I understand them currently, these new regulations are heavily deflationary and will force people to involuntarily de-lever across the financial system. So that's just, I thought Mike was spot on there. Briefly on the role of the FSB, I think they've done as much as they possibly can. They can't enforce they have no jurisdiction, if you wish. But I think what they've done most of all is a wonderful educational role for those who care to read the FSB documentations, and they should be congratulated for that.
Marshall?
Well, there has been criticism about the fact that there has been artificially imposed deadlines, but my experience has been that if you don't impose some sort of deadline, nothing ever gets done. And, you know, I think it is... there may be a justification for some period of grace, but I think you do need to have a policy impetus, and also you have to consider the complainant sometimes. If I hear Jamie Dimon saying, "Well, I need more time to do that," well, I think it's he doth protest too much. So I think that's a very important consideration to bear in mind when we look at this particular issue.
Eric.
So the only comment I would close with is that the FSF historical experience is a very depressing one, that there was an enormous amount of excitement when it was first created, 2 or 3 years of all kinds of activity, and then it became a moribund institution. And in my view, the FSB faces potentially the same fate if its recommendations are not seen to be implemented and be effective. And particularly if we experience further instability, as James is reminding us is quite likely, countries will increasingly lose faith in that institution and resort to unilateral actions. And so that may be the outcome, but we should be able to try to constrain that with some forms of hard law in the meantime.
Thank you. CIGI?
Yeah, and at the end of the background paper, Pierre mentioned why the in the last several decades, policy making has improved and the economic system shows some resilience, but why financial crisis remain far too commonplace? I think the crisis embedded in the financial activity. You're financing short-term and investing in long-term. It has involves the risks, and the regulation and supervision framework are different from countries to countries, and it leads to regulatory arbitrage. And so to avoid future financial crisis, we should we should put more efforts in revising the incentives to cooperate on reform the financial regulations further. Thank you.
Well, thanks very much. I won't try in closing to summarize. I think we'll have the benefit of John Helliwell's. I'm sure he'll do a very good job of that. But I will note that basically we end where we started, I think. I hope I'm not too presumptuous. But we're still grappling with how we balance domestic versus international responsibilities when it comes to financial regulation, the regulation of capital flows. And in a parallel, we'll also sort of grappling with sort of how much complexity we permit in our financial systems, and where we draw the line to limit the damage when the financial system, at least according to some, behave irresponsibly. So with that, I want to first, and I think we should all thank the panelists for their very interesting comments. I've been also asked to let you know that, of course, lunch will be served, and we reconvene at 2 p.m. So with that, let me thank all the panelists, and please join me in thanking them. Thank you. Interesting to my time, in my case, is that the spread of crises is not constant over time. In some crises, and I gave the example of the Asian financial crisis, it affects one part of the world, but not the other. But in this particular crisis, although the severity of the effects varied, in this crisis, basically the entire globe was affected to a greater or to a lesser extent. And then beyond whether economies were coupling or decoupling in terms of their business cycles, we saw something that was not as evident in many of the other crises in the past, which is the spillover from the financial sector onto the real economy. Many thought that you could sort of ring fence effects from the financial sector onto the real economy, but we now know that the two are intimately related. If we then step back and look more closely at the differences between emerging markets and advanced economies, the other thing that's notable about the latest crisis is how in the emerging markets, one of the reasons they may have weathered the crisis better than others is because, if you buy the data that I use at least, they allowed monetary independence to increase. So they were able to absorb the shocks from abroad. And at the same time, financial openness also rose. After all, some, but not all, these emerging markets don't have financial systems that are as sophisticated as ours. But the global financial system allowed them access to funds outside their own country. So the combination of greater monetary independence and financial openness helped them absorb some of the shocks. And you can also see that if you look at classifications of exchange rate regimes. Interestingly enough, in the emerging market groups of the G20, you saw them, on average, aiming or tending to allow their currencies to float more freely, whereas a slightly opposite was true of the advanced economies. Again, this is all dependent on whether you buy these classifications of exchange rate regimes. So that's the background. Now, in terms of the response, what do I see as some of the dangers? And I'll focus on three. One, if we look at the fiscal response, we saw that it was fairly immediate and fairly large, although, again, if you look at the IMF's work in this area, you will see that the fiscal response was considerably larger in the advanced group of the G20 than in the emerging market group. But similarly, we find that the U-turn towards austerity was also much sharper in the advanced economies than in the emerging market economies. And so we somehow see that emerging markets perhaps learned another lesson that some of the advanced economies did not, which is it's fine to argue that when the crisis is over, you should restrict fiscal policy somewhat, but perhaps not to the same degree or at the same speed as in the advanced economies. And then the second danger, which is a little bit closer to my heart, and I find it both more problematic and complex, is that central banks became essentially the only game in town. And there was a tendency for politicians and policymakers more generally to assign more responsibilities to central banks without having thought through what are the consequences. And so in some economies, of course, financial stability.
And this raises an awful dilemma for central banks. Now, I should not say all central banks, merely those central banks who, over the past, say, decade or two, have been charged with financial supervision and financial regulation. So we could argue that central banks, the ones I defined, have allowed the financial system to evolve in ways that perhaps it should not have. And those central banks now find themselves struggling to adapt their lender of last resort responsibilities to the new reality. And as a matter of fact, under Dodd-Frank, it is not impossible, but it's much more difficult for the Federal Reserve to deploy Section 13(3) of the Federal Reserve Act, which is how they prevented the entire implosion of the US financial system during the crisis. So there's that dilemma for central banks, and yet at the same time, their stated policy intention, again in some obvious cases, at the same time their stated policy intention is to sustain an addiction to a level of growth and a level of leverage in the financial system that is neither sustainable nor consistent with real economic growth. Apart from that, it's all good. But in terms of regulation, which is obviously one of the key areas we're going to discuss now on this panel, one thing that concerns me is that the solution to what we've been through over the past 5 years is always and everywhere to have banks hold more capital, which is understandable, but also hold more and more liquid assets. The problem with that is that the liquid assets, the financial system, not just the banks, but the financial system are forced to hold are paper claims issued by countries in very parlous fiscal situations led by the United States. It is true to say that T-bills, US T-bills, make the world go round, or at least those are the instruments that underpin the entire financial system, and to a lesser degree, Treasury notes as well. So that's the first thing that bothers me, and if I was to imagine what the next financial crisis might look like, my bet would be it would be a crisis in so-called safe assets. Related to that, there is the assumption that because you hold more liquid assets, you are liquid. Nothing could be further from the truth. It depends where you hold them, it depends how many times you've relent them, and so on and so forth. And finally, just briefly, Pierre, on the FSB, obviously it's run by chaired by a very capable man. Governor Carney is but one of but two G7 central bank governors with any practical, non-model driven financial markets experience. And I think that goes to part of the problem as well. Thank you.
All right, thank you very much for staying on time. So next we have Marshall Auerbach from INET.
Thank you, Pierre. And I'll second James's comments about thanking Rohinton and the other members of CIGI for inviting me to speak at this august conference. I will try to link this marginally to the...
became an additional objective, but we still don't have a consensus on what we mean by financial stability, how we regulate it or control it. And then there's a tension between financial stability, generally speaking, and monetary stability. We have a fairly good idea of monetary stability. It's something that's forward-looking. It has something to do with price stability. We can argue whether you need an inflation target, a formal one or numerical one or not, but that's what you need for monetary stability. But financial stability tends to be more backward-looking. When we think of these macroprudential instruments, they tend to be backward-looking instead of forward-looking, and ideally there should be some forward-looking element to it. And that gets us to the third danger, which is there's a danger that we learned the wrong lessons from the crisis, and in particular when it comes to capital controls. It was mentioned in the first session that some economies instituted some types of capital regulations, but for the most part, the emerging markets avoided that. They used that as a signal from time to time, but contrary to some of the more recent research at the IMF, which is suggesting that maybe under certain circumstances capital controls might work, most emerging markets have sort of taken a more neutral position. And in fact, if you look at the extensive literature on capital controls, you'll certainly find some evidence where it's worked. But broadly speaking, the lessons are that we really don't know if it does work and when it does work. And so perhaps it's best to leave well enough alone and try to avoid capital controls wherever possible. So with the background and some of these dangers in mind, how do we go forward? Well, at least from my perspective, I've come up with sort of 5 suggestions. At least I would say only perhaps one of them might be novel. The others you'll find mentioned by others in several publications. One is, I think I was hinted this morning, which is that countries should get their own house in order. And that means achieving some kind of balance or harmony between fiscal and monetary policy. Cooperation is certainly desirable, and certainly more desirable than coordination, but rather than try to find a narrow set of rules, it's probably better that countries develop an acceptable range of behavior and then allow them to operate within that range. How wide that range is a difficult question, which I won't deal with here. Third, transparency is very desirable. If you look at central banks in particular, and particularly in emerging markets, the amount of monetary policy transparency has risen quite substantially over the last 2 years. Of course, they had much further to go than the advanced economies. But transparency is necessary, but is not a sufficient condition. The important problem is, where does accountability lie, whether it's for monetary policy or more generally financial system stability. And so as a result, the fourth idea is that, and I think this was sort of hinted at the first session, but I have a slightly different take on this, is that it's probably best to have accountability reside with the individual countries rather than, which is typically often the case, the international financial institutions. When something goes wrong, you tend to go to the international financial institutions, or it's these institutions that apply moral suasion. Whereas it's probably best to design a system. All right, if everyone is ready, we'll start. As you can tell from the screen, this session is about global financial regulation and the governance of capital flows. And my name is Pierre Siklos, and I'm affiliated with the Bosley School next door, as well as Wilfrid Laurier University. And of course, I'm also a fellow at CIGI. And like the previous session, I'll begin with some remarks and then turn it over to the panelists. When I was asked to write the background paper for this session, I thought I would do a couple of things. First, I thought I would organize my thinking by focusing on the G20, not so much because of whether it's the legitimate organization or group, but simply because, given that we are at CIGI, it seemed to make a lot of sense. Also because the other advantage of doing it that way is that you have a nice subdivision of countries that are considered to be advanced industrial economies and emerging markets, and there's some interesting differences between the two groups that I found useful in organizing my thinking. And then lastly, because I was asked to not just to relate the problems and the challenges, but to provide some idea of the way forward. If you'll forgive a little French, there's a famous French expression, la critique est aisée, mais l'art est difficile. And essentially, it means it's easy to criticize, but to provide some constructive solutions is a lot more difficult. So with that in mind, in organizing my thinking, the first thing was very clear when you focus on the G20 and you look at the last several decades, it's very obvious that if you classify financial crises, whether they're systemic banking crises, currency crises, or sovereign debt crises, there's a marked division between the advanced economies and the emerging markets, with the latter having experienced many more crises of all kinds than the former. But of course, the former is notable because the latest crisis is considered to be a systemic banking crisis, among other things, and it's centered in the advanced economies. And if you have access to the paper, I'll not point to particular figures. You can look at that on your own. The other notable aspect, of course, of the last crisis is a systemic variety. It's the systemic component, which was not as present, say, in the Asian financial crisis. Although at the time, certainly even in Canada, we thought that the Asian financial crisis might spread beyond the Asia Pacific. And then, of course, because it's systemic, we tended to think of crises, whether they're financial or other varieties, we tended to ignore sort of the interconnectedness and the complexity of financial institutions. And clearly in the last crisis, that's become very much a focal point of the debate about how to regulate finance and, by implication, capital flows. But beyond the classification of crises, the other thing that, at least in preparing the background paper, I found a system where you have an escape clause, which allows individual nation states to step out, if you like, of the rules of the game. But then the responsibility is, it's incumbent on them to explain to the international community why they feel that the current system does not work for them, rather than the other way around. And then lastly, when it comes to the G20, one of the motivating, one of the sources for the creation of the G20 was to group together systematically important economies, which is on the surface a good idea. The problem is that you then face the problem of what economists refer to as Goodhart's law, which is that once everyone knows that these economies are the systematically important ones, you tend to forget that there might be another economy down the road which, to your surprise, might eventually become systematically important. So we discussed last night the issue of the size, the legitimacy of the G20, and those are, I think, important issues. But just to organize a group of countries along the lines of ones that are currently systematically important can raise some difficulties. And I think with that, I'll stop there, and I'll turn over the discussion to the panelists. And like this morning, each has 5 minutes, and you have their biographies, and so I don't need to say too much. And we agreed that we would go in on an alphabetical basis, so we'll begin with James Aitken, please.
Thank you, Pierre, and thank you to Jim Haley and the event organisers for including me in this wonderful and interesting discussion. Raise your right hand if you feel you understand how our financial system works. Good. Don't worry, you're not alone, but I think that goes to the heart of some of the problems that continue to bug us 5 years after the crisis. By way of setting the scene, since the end of Bretton Woods, our financial system has evolved from one that was funded by intermediaries to one that was financed by markets. And there is, of course, a very big difference between the two. The first one is that the magnitude of the extent to which the financial system is now critically dependent on market-based funding. Essentially, our financial system is leveraged maturity transformation on unstable foundations. And those unstable foundations include things like tri-party repo, money market funds, of course, and wholesale funding in general. In other words, what we have is a financial system which engages in leveraged maturity transformation on a bed of hot money for which there is no backstop and no obvious lender of last resort, and which, of course, dominates the entire financial system. The second big difference, if we compare, say, the early 70s to today, is the technologically enabled speed with which such hot money financing can be assembled and, of course, withdrawn.